This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this lecture is on chapter 24 of the free lecture notes, which is on interest rate risk management. You'll remember the previous chapter had a lot of lectures because there's a lot to go through on foreign exchange risk management, interest rate risk management. You can't be asked numbers on it. But you are expected to be aware of what the risk we're talking about is and how it might be managed. But hopefully it will be a lot quicker going through this side of it. But again, it's not a numbers problem here. It can only be what I call written questions. Anyway, first of all, be clear what it is we're talking about. And for some people it's almost too obvious, in that if we borrow money, any company stands to be borrowing money, then of course we're paying interest. And the risk is that interest rates do change. Interest rates today may be 10%. By next month they may have gone up to 15%, or they may have gone down to 5%. And the fact that we're never certain what the rate of interest we're going to be paying is, that's the nature of the risk. However, there's an easy way of perhaps getting rid of the risk. If you borrow money, there are two ways of borrowing. You can either borrow at floating rate, and if you're borrowing at floating rate, then day by day you're being charged, or whatever the interest rate happens to be, charged actual interest rate from day to day. So clearly there's risk. I borrow 100,000 at floating rate. Today they're charging 10%, but I've no idea what rate we'll be charging next week or the week after. Clearly, may end up paying more, may end up paying less. The easy way round that is to borrow at fixed rate. And if you borrow at fixed rate, all right, I take a loan from the bank. They tell me today what the rate will be, and that rate is then fixed for the term of the loan. The interest rate fixed at the start of the loan. So, of course, if I borrow at 10% fixed rate, then it's irrelevant to me what happens to interest rates in the future. I'll be paying a fixed 10%. There's no risk. It's a fixed amount. So that may seem the end of it, except that even borrowing at fixed rate, there can still be a risk. And the reason is this: if I need to borrow the money today, I'm borrowing 100,000 today, they quote me 10% fixed rate, fine, that is fixed. But what about this? I will need to borrow, let's say 100,000 in 3 months' time. I want to borrow at fixed rate. The fixed interest rate quoted today is 10%. But I'm not borrowing the money today. If I was borrowing the money today, fine, it's fixed at 10%. My problem is the risk is what rate will they be quoting in 3 months' time? I don't know why I'm writing all that down, but still. But that's my problem. I'm not borrowing money today. I'm going to need to borrow money in 3 months' time. And even though today they're quoting 10% on fixed interest borrowing, obviously in 3 months' time, they may be quoting 12%. They may be quoting 8%. If I just simply wait 3 months and then go to the bank and take the loan, there is risk. I don't know how much to budget for the interest because we've no idea what rate we'll be quoting in 3 months. And so that is the risk we're talking about for the rest of this chapter. How can I remove that risk? How can I make sure that, if you like, I'm certain of what the rate I'm going to be charged is for a loan starting on a future date? And if you turn over, there are 4 ways of removing that risk that you're expected to be aware of. Forward rate agreements, interest rate guarantees, interest rate futures, interest rate options. And let me explain each one. First of all, the most important one for the exam is what we call forward rate agreement, or FRA. And what this is, I go to the bank today, I tell them I'll need to borrow 100,000 in 3 months' time. And they'll quote me a rate now, which will apply to a loan starting on a future date. It's interest rate quoted today, interest rate fixed today, for a loan starting on a fixed future date. Let me show you what I mean. If you look at 4.1, if we ask the bank to quote an FRA 3 to 9 on 100,000, well, what it is this. I go to the bank, I say I want to borrow 100,000. I tell them how long I want to borrow for, let's say for 6 months. But we don't want to take the loan today. We want it to start in 3 months' time. So I'll have to tell the bank how much I want to borrow, clearly, how long I want to borrow it for, and when I want the loan to start. And the bank will then quote me a rate, a fixed rate. They might say, okay, currently the rate's 8%, but because your loan's starting in 3 months' time, we'll quote you 10%. And it's up to me whether to accept that quote or not. But if I accept the quote, then that's the rate I'll pay, regardless of what the actual rates happen to be in 3 months' time. I mentioned terminology. The terminology that goes with it. Again, obviously, the bank will want to know how much you're borrowing, how long for, and when it will start. Well, you ask them for an FRA, a forward rate agreement. You tell them the amount, 100,000. And the way we tell them that it's 6 months and it'll start in 3 months' time, we call it an FRA 3 to 9. 3 is the start date of the loan. 9 is the end date. So I want the loan to start in 3 months, and because it's a 6-month loan, it'll finish in 9 months. And so there we are, the easiest way of all, it's then fixed. It actually works in a slightly funny way, that suppose the bank has come back and quotes 10%. I haven't paid any money or anything, we've just agreed that it'll be 10%. What actually happens is at the start of the loan, I'll show two examples. Suppose the actual rate on that date is 11%. Well, they promised me a fixed rate of 10%. But what actually happens, it's almost as though there are two different departments in the bank. I actually have to pay the actual rate 11%. But then because the bank promised me it would be 10%, that was the fixed rate they quoted, the bank gives me back 1%. So the net effect is I do pay 10, but it's as though it's two different departments. The lending department charges me whatever the rate is. The bank who quoted the rate, or the department rather, that quoted the fixed rate, they give back the difference. Or equally, if the actual rate turned out to be only 9%, well, the department that's actually giving the loans, they'll charge me 9, I'll have to pay 9%. But because I'd agreed to accept this fixed rate, this time, the department that we agreed it with, I'd have to pay the bank the extra 1%. So the end result, I say it works in a slightly funny way, but I'm not over concerned. The end result, whatever happens, is that if we've agreed the forward rate, then whatever happens, I end up paying 10%. I can't pay more, but at the same time, of course, I can't pay less. That's an FRA. The next one is an interest rate guarantee, or an IRG. And what this is, it's a bit like an option, because you see, the forward rate, using the forward rate agreement, as I said before, if the actual interest rates go up, great, I fixed at 10%. If rates go down, well, I don't get the benefit. I'm still fixed at 10%. And if I was pretty sure that interest rates were going to fall, then of course I don't want to be fixed at 10%. I'd rather pay the lower rate. But the danger is I think interest rates are going to fall, but of course I could be wrong. What happens if they go up? Then I've got a problem. Well, with an interest rate guarantee, you tell the bank what the maximum you want to pay is. Suppose I'm happy to pay up to 10%, but I don't want to pay any more than 10. But on the other hand, if the interest rates fall, then I want to have the lower rate. I go to the bank and I say I want an IRG on, let's say, 100,000 again. 3 to 9, same idea. It's going to be a loan that starts in 3 months' time and finishes in 9 months' time. And I want an IRG at 10%. The bank will quote me a price for that. The bank will charge me a premium. Then, let's say, they can charge me whatever they want. Let's suppose they charge me 5,000. But the beauty of this is that when it actually comes to the start of the loan, if first of all actual interest rates are 12%, Well, I've got this IRG. They're guaranteed a maximum of 10%. And so we'll use this IRG and we'll actually pay only 10%. But on the other hand, if the actual interest rates have fallen and are only 8%, well, fine. In that case, I don't use the IRG. And I'll pay the actual rate of 8%. So you can see what I mean when I say it's like an option. IRGs are fixing a maximum rate. But because you can only win, you can't lose, if you understand me. If rates fall, you get the benefit, but if rates go up, you're limited. The bank will charge. They can charge whatever they want. You know, I said 5,000, but it's whatever they want to charge. And that 5,000 would be payable whether you use the IRG or whether you don't. Again, it's like taking insurance. Pay the 5,000. Hopefully, it was wasted money because interest rates fall and you don't use it. But it does mean you're protected, that if interest rates do go above the limit, well, you have that limit, you won't pay extra. A bit of terminology there. When you're using an IRG, if you're borrowing money, then of course you want to fix a maximum interest rate. And the word we give it, we say it's a cap, an interest rate cap. We've got a cap in my example of 10%. It's a cap, you know, you put a cap on your head and you can't go any higher. A cap is fixing a maximum interest rate. If, on the other hand, you were depositing money, which is less likely for a company, but still, if we were depositing money, then again you can buy an IRG, but surely if you're depositing, you want the situation where if interest rates go up, great, you'll earn more and more interest, great, but you want to protect yourself in case interest rates fall. Surely you want to fix a minimum rate. Well, if we're fixing a minimum interest rate, we call it a floor, because the floor stops me going down any further. So if I'm borrowing, I want a cap, so I can't go any higher. If I'm depositing, I want a floor, so we can't go any lower. Okay, so that's interest rate guarantees. In a similar way to foreign exchange risk, although here I'm talking about going directly to the bank and they quote you a premium, there are, and it is effectively an option, there are traded options where instead of going to the bank, you get it through effectively something like the stock exchange. However, they are really messy and certainly not relevant for F9. Traded options, it's P4 where you'll see what happens. So that's FRA's IRGs. The next one is interest rate futures. And there is a similarity, as you'll see, to foreign exchange futures. Because with foreign exchange futures, I said as the spot rate goes up and down, we gain or lose. We leave that at risk. But to cancel the risk, we deal in these futures, where as the spot rate goes up and down, the futures price goes up and down, but they go in different ways. It cancels the risk. Well, there are interest rate futures available that work in the same sort of way, but they are a little bit funny. And I will explain with a little example, but be careful here, it is a bit messy. Don't learn what's coming. I'm just trying to show you basically how they work. But you cannot be asked calculations on these in paper F9. But I still think it's worth me showing you a little example to make it clear. Obviously, interest rates go up and down. Maybe 10% at the moment, it may go up to 12, it may go down to 8. There are interest rate futures available, but rather than quote them as an interest rate, they quote a price, which is 100 minus interest rate. What I mean is, if the interest rate is 10%, futures they don't quote as a percent. They take 100 minus 10. The futures will be quoted at 90. They give it a price. They say, well, the future costs 90. On the other hand, if interest rates were 8%, the futures price is quoted at 100 minus 8. The futures price would be 92. If the interest rate was 15%, futures price 100 minus 15, 85. Now, for what's coming, it is quite important to realise that as interest rates go up and down, these futures prices go up and down as well. But they're going in the opposite way. A lower interest rate rather, means a higher futures price. A higher interest rate means a lower futures price. Let me show you how it works. Example 1. Today is 3rd of October and interest rates are 8% per annum, and we want to borrow 6 million for 6 months, starting on the 1st of January. Now, again, we're not going to borrow the money now, but just suppose if we did borrow now, how much interest will we pay? We're borrowing 6 million. The interest rate is 8%, the quoting interest rates of 8% a year, but we're only borrowing for 6 months. And so the actual interest we'd be paying if we borrowed now, 6 million, 8%, half a year, is 240,000. However, as I say, we're not borrowing now, and that's the problem. We're going to be borrowing on the 1st of January. And of course, by the 1st of January, the interest rate may have gone up or down. We're at risk. It may have gone up to 10%, it may have gone to 8% or whatever. And so, rather like foreign exchange futures, we will leave the transaction at risk. I'll illustrate with figures in a minute, but it means that when we come to borrow in January, whenever it is, we'll pay whatever the interest rate happens to be. But to cancel the risk, we'll start today a futures deal. And what will we do? Now think about this. There are futures available. The price at the moment is 92. 8%, 92. We are worried, we're borrowing money, so we're worried the interest rate will go up. What will happen to the futures price if the interest rate goes up? Think back to what I said. If the interest rate goes up, it's currently 8% and the futures price is 92. If the interest rate goes higher, the futures price goes lower. So if interest rates go up, I'm paying more interest. I need to deal in futures that'll give me a profit to cancel the extra interest. And the way we do it, we will sell futures today at today's price, which is 92, and then we'll buy back on the date of the transaction. Now, I've already said don't worry too much because you can't be asked numbers. Some people found that awfully strange. How on earth can you sell when you haven't got any futures? Doesn't matter. You ring the dealer, and remember from the foreign exchange one, it's just simply a phone call. Buy futures, and then a week later, a month later, sell futures, and you get the profit or paying the loss. Well, equally, you can ring the dealer and say, sell futures. And then later, you have to ring him later and say, buy futures. And then they work out what's the profit or the loss. And so we will sell today at 92. And if interest rates go up, the futures price will go down. And the difference between the two will be our profit. You'll notice the question says 3-month January interest rate futures are available at 92. January futures means that we must finish the deal by the end of January. That's no problem. Today's 3rd of October. The loan starts on 1st of January. We will finish the deal. When it says 3 months interest rate futures, it means when they come to calculate the interest, the gain, 92 is like 8%. But when they calculate profit or loss, they'll work it as though it's yearly interest calculated for 3 months. It's really odd, but it always works like this. And so what we'll do, and you'll see why in a minute, because we're borrowing for 6 months, and interest on futures is only calculated for 3 months, we'll buy 6 over 3, 2 times the amount of the loan, 6 million. You'll see why in a minute, because now let's see what happens on the date the loan starts, which is 1st of January. First of all, the loan interest. We borrow the money at whatever the interest rate happens to be. And he says, assume, at the bottom, assume interest rates have changed to 10%. Well, we're borrowing 6 million. The interest rate when the loan starts is 10%. But again, it's a yearly rate. We're only borrowing for 6 months. And so we'd end up paying interest of, I think it's 300,000. Which of course is a lot more than if we borrowed now. Interest rates have moved against us. We're losing. However, on the same day, we will finish the futures deal. And what happened? The futures deal, today I have started the deal, and I told him, the dealer, I wanted to sell 12 million. At what price? 92. On the date the loan starts, we finish the deal, we'll ring the dealer and say we'll buy futures. And the question says, interest rates have gone to 10, futures price has gone to 90, 100 minus 10. And they say, okay, it's changed by 2, which is effectively 2%. And they say, right, how much did I have the deal on? 12 million. And here, now you're going to see why we have the deal on 12. Because they say, okay, your gain, the movement is 2%. So 2 over 100. But, and this is the strange thing which don't learn at this stage, but although always that's equivalent to a yearly rate, 2%, they always, with interest rate futures, calculate the gain or loss as though it's for 3 months, 3/12. It's 2% a year, but futures are always 3 month futures. They always take 3/12 of it. And so, how much will our gain be? 12 million, 2%, 3/12. Our gain is 60,000. We'll receive 60 from the dealer. And what's the net result? Pay 300, receive 60, a net payment of 240,000, which of course is what we would have paid had we raised the money today. Now, as I say, that 3/12 may be confusing, but sorry, but it's nothing to worry about until P4. But you know, if I was showing you an example, I have to do it properly. More importantly, though, is the principle that if interest rates are higher, we're losing on the interest, but we make a compensating gain on these futures. And equally, if it had gone the other way, if interest rates had gone down to 6%, we'd have paid less on the loan, we'd have gained. But had interest rates gone down to 6%, futures price would have gone up to 94. We'd have lost money on the futures deal. So here, lose on the loan, gain on the futures, they cancelled out. If interest rates had fallen, we'd gain on the loan, but we'd lose on the futures. Again, they'd cancel out. Again, a bit like financial futures, things don't in fact work perfectly because futures prices do move up and down with interest rates, but it's not always precisely 8%, 92, 10%, 90, and so on. There's slight differences. So in practice, it doesn't work out perfectly. But you know, when it's big amounts, we're not worried about a few hundred or a few thousand difference. Over the page, interest rate options I mentioned before, caps, floors, and collars. Well, I've explained a cap and a floor. There are situations, but again, it's really P4. A cap, you're fixing the maximum rate, which is relative to your borrowing. A floor, if you're depositing, you're fixing a minimum rate. There are situations, but this is P4, where you might want to fix a maximum and a minimum. Well, if there's a maximum or a minimum, we call it a collar. Over the page, back to fixed and floating. I said right at the beginning, our business always has the choice of borrowing at fixed rates or borrowing at floating rates. Now, there's an obvious merit in borrowing at fixed rate because you're then guaranteed what you're paying. There isn't that risk it might be higher or lower. But when floating rate might be of benefit, is if your income, whatever we're selling, if our income tends to go up and down year by year with interest rates, if we're a bank, for instance, our income goes up and down with interest, then it could make sense for your borrowing to be at floating rate, because if interest rates go up, we get more income, and okay, we pay more interest. If interest rates go down, we receive less income, but we'll pay less interest. So there are some businesses that would actually prefer to borrow floating. And because of that, what we call an interest rate swap may be worth considering. Yet again, you can't be asked numbers, but an interest rate swap is where we've got two companies both borrowing money and they swap their interest payments. And let me show you with a tiny example. Again, you can't be asked numbers, but a tiny example of why or how that might be beneficial. Look at example 2. Company X can borrow at a fixed rate of 10% or a floating rate of LIBOR plus 3%. Now, LIBOR is what we call the London Interbank official rate, and it's the floating rate that goes up and down. But any one company will have to pay a bit more than the official rate, depending on their credit worthiness, how risky they were. So if you're borrowing floating rate, the bank always takes what they call the official rate and then adds on a bit depending on how risky you are. So they can borrow at a fixed 10 or floating of this LIBOR plus 3. Now, Company Y, they're perhaps not as good at credit risk, so when they go to the bank, they're quoted 12% if they borrowed fixed. You know, if they're a more risky company, the bank charges a higher rate. And if they want to borrow floating, again, a higher rate, LIBOR plus 6.5. X wishes to borrow at fixed rate. Y wishes to borrow at floating. Well, if we ignore any mention of this swapping business, if they do their own borrowing, X wants to borrow fixed, they'll pay 10%. Y wants to borrow floating, they'll pay LIBOR plus 6.5. And so, assuming they wanted to borrow the same amounts, in total, they're paying 10 plus that, LIBOR plus 16.5%. Well, a way they could potentially save money, not always, but potentially, is let's have them borrow the opposite of what they wanted and then swap. What I mean is this. X wants to borrow fixed, but for the minute, let's suppose they borrow floating, they'll pay LIBOR plus 3%. Y wants to borrow floating, for the moment, have them borrow fixed, and they'll pay 12%. And again, assuming both companies wanted to borrow the same amount, they arrange that borrowing, but then they pay each other's interest. X pays Y's interest, so X pays 12. Y pays X's interest, LIBOR plus 3. And in total, how much will they be paying then? LIBOR plus 15. They're saving 1.5%. Now, of course, couldn't quite leave it like that, because although Y is delighted, borrow themselves and they're paying LIBOR plus 6.5, they're now only paying LIBOR plus 3. They're saving 3.5%. X is going to be pretty annoyed. They're not going to be happy because they would have been paying 10%, do all this swapping, and end up paying 12%. However, because overall they can make a saving, they'll share the saving between them. And what in fact will happen, to make it all work, Y will pay X each year. I'll show you I've got the figure in a minute, but they'll pay X 10 2.75%, which will mean Y ends up in total paying LIBOR plus 5.75% each year. They're paying it to X, so X receives 2.75, and X will end up net payment 12 minus that 9.25%. And what's happened, you see, is they both end up saving 0.75%. X would have paid 10, ends up paying 9.25. They've saved 0.75%. Y would have paid 6.5, only pays 5.75 above. They've saved 0.75%. So again, doing it's a bit messy. You won't be asked to do it in the exam, but that's what a swap is. And that's why people might do it. It doesn't always give a saving, but potentially it can give a saving. And again, how do you find the other company? Well, banks have departments which will arrange this. They've got lots of companies wanting to borrow fixed. They've got other companies wanting to borrow floating. They will sort of match you and potentially save money. Okay, so that's the end of that. Can I repeat one last time? Although the examiner can and has tested that you understand basically each of these ways: futures, FRAs, IRGs, swaps. You cannot be asked arithmetic on them in F9. Again, the reason I've been through a few examples is I just think, I hope, it makes it a little bit more clear than simply saying it all in words.